I say this all the time. It's not timing the market. It's
Time
time
in
in
the
the
market.
market,
Yes,
right?
100%.
And so, look, if you buy a stock today and it goes down and you sell it, what happens? You lose money. But if you buy a stock today and it goes down and you hold on to it, and then in the next 5 years or 6 years, it goes up and gives you a return, have you lost any money? No, you only lose when you sell. So hold on to those property, and you should be buying with a buy and hold strategy anyway, unless it's your primary residence and you've made enough on that where you can get the tax benefit of the 250 or 500,000 if you're married, tax exemption, and roll that into something bigger and better for the next one. If it's not that, hold on to the property long term. It doesn't make sense to sell it for any loss because you can pull out that money when it does appreciate. You can pull that money out tax free.
All right, guys. Today, I got a good friend of mine on the podcast, repeat guest for the second time, and he is doing big things in the lending space and big things in disrupting the market in terms of how people are going to buy and sell homes. I got my man, Brad Rice. Brad, welcome to the show.
Thanks, brother.
Yeah, dude. It's
Good
been
to
a
be
minute.
here.
Yeah, I know. It's been a minute, man. I appreciate you coming down. It's cool to see Micah here as well, your videographer.
That's right.
I went on your show last time we connected up in your office up there, Thousand Oaks, man. It's already been almost 2 years.
It has been 2 years. Yeah.
Time flies,
Crazy.
man.
Time does fly.
Yeah, time
Yep.
flies. So, anyways, man, so much game, so much value that we're going to spit here, and a lot to talk about in the capital markets, the lending markets, real estate. But to start things off, man, we got a new Fed chair that's just been nominated by President Trump a week ago, Kevin Warsh. And, the Fed did 3 consecutive rate cuts to end 2025. We've been in a high rate environment for 48 months now. We're in February 2026 as the date of this recording. And if you remember correctly, the first rate hike was February 2022. It's been 48 months, which is crazy. If they would have told you 4 years ago that rates would essentially double and housing prices would be relatively untouched, would you have believed it?
Yeah. It's this is definitely the longest, most extended rate environment where they've been elevated in my career. And I started in the business in 1993. And so, yeah, probably it wasn't expected, but I think there's some nuances to it that people also didn't expect. The fact that there's not as much housing for sale out there because of the low rate environment, people not wanting to get out of there at 2 and 3% interest rates. The lack of inventory has caused prices to stay relatively stable. So we're not, we are seeing some areas that we're really overbought, but and those areas have come down more. But for the most part, I think most people would say when they're talking about their own residence that it at least is worth very close to what it was before. Maybe not
Which
quite
is
at the
crazy,
high.
though, because would you have believed that 4 years ago if someone said, hey, we're going to double the rate environment for 4 years and housing prices in most markets around the country would be relatively untouched?
Yeah, nobody would.
I
You
don't
wouldn't
think
think
anyone,
that.
I wouldn't have believed it.
Yeah, you would think there'd be a crash, but there hasn't been. And I know people like to predict that there will be. And you know what? If they're right, they'll boast about it. But if they're not right, you'll never hear from them again. So who cares? So, but yeah, we've seen prices are somewhat stable, and it's just because of the lack of inventory. But we are seeing rates come down now, and I think that we're going to see more Fed cuts very soon. We just see that in the last week here with the jobs market is weakening, and there's definitely headlines that cause the Fed to really want to consider a lower rate environment, and I think we're going to see some more cuts very soon.
Yeah. I want to make sure I get this gentleman's name right. Kevin Warsh. I just confirmed it is Kevin Warsh, Warsh. But before we get to the new Fed chair and kind of predictions in the interest rate environment and that sort of thing in 2026, I want to ask you, with the housing prices being relatively untouched for the last 4 years, with the rate environment doubling, do you think some of this is due to the due diligence that is now performed on buyers and borrowers before they buy and secure lending to buy a primary residence? Because, in 2008, you've been in the game for a while. You guys were doing, stated income loans, no doc loans, stated income loans for people to buy. And that drove up the market. And then all of a sudden everything collapsed. Now, obviously, to get into a home loan now, there's a lot of due diligence that goes into it. And so do you think some of the blame, or not blame, but some of the reasoning that we haven't seen a big crash is because it's been good borrowers getting into these loans?
Yeah, good borrowers definitely play a factor in the fact that we're not seeing the foreclosures accelerate. We're not seeing people losing homes. We're not seeing the decline in the market. But I will add to that,
Mm-hmm.
the market is loosening up when it comes to underwriting guidelines. We are seeing more and more creative financing now than we even saw a year ago or 2 years ago. So let me give you an example. We've all heard of DSCR loans,
Yes.
debt service coverage ratio. So all that really means is, will the property serve as a payment for what you're going to owe on that property every single month? Are you going to be able to collect enough in rents to cover your principal, interest, taxes, insurance? And we call that a 1-to-1 ratio if it's even. Okay. And we can go 1.2 to 1. We can go 1.3 to 1. We can even do 0.8 to 1.
Yeah, and just to give the listeners a little context, so in the commercial real estate space, the DSCR loan product is really how all loans are sized up. And most lenders regardless of asset class in commercial real estate, so whether it's retail, office, hotels, hospitality, multifamily, most lenders are going to be in that 1.3 range, meaning they want 130% of the revenue to cover the expenses. That way there's a little bit of buffer in between, extra 30% buffer in between. So what kind of guidelines are you seeing today with some of the residential stuff?
Well, first of all, you're right. So DSCR has existed, and that is how commercial loans have been underwritten forever. So it's really funny that they took that concept, which really works, right? Because when you buy commercial property, it's not that you have to prove enough income on your tax returns to qualify to buy it. The property has to serve the note. And
Yes.
so
The,
they
the,
took
the landlord could be unemployed and be bringing in zero income. But the property is self-sufficient because it's going to generate enough income on its own to support the debt. And that's how a lot of those deals are sized up.
Exactly.
Yeah.
And so it's really clever. They took that and they said, let's put that into the residential market and allow people to buy properties for investment and use the income from that investment to make the payments. So that was a groundbreaker. That happened about 4 or 5 years ago. DSCR started to come on the market. Originally, it was super tight. You would have to be at like 120% or 130%. Now we can go less than 100%. We can do 0.8 to 1, which means you're not even covering the entire payment with what you're expecting in rent. And by the way, when people are talking about DSCR, they do what's called a rental survey when you're buying a property. That rental survey is kind of an add-on to the appraisal. The appraisal determines the value of the property to make sure that you're paying what it's worth, at least, what it's worth. And then the rental survey says, well, here's what the expected rents are based on what other things are renting for that are similar in the area. So we use that to determine the coverage.
Sure.
And then we can do 0.8 now. I mean, it's gotten aggressive. So when I talk about the products being more aggressive, not quite to those subprime days where you could do zero down and have a bankruptcy yesterday. That's not what we're talking about here, but we're talking about logical underwriting and ATR, ability to repay. So that's the main factor here that's used as a litmus to determine if you can give somebody a loan. Do they have the ability to repay that loan?
And are you looking in this for the ATR, looking at the borrowers like, hey, what is their scheduled real estate own? What is their net worth? And what is their income outside of this deal?
That all plays factor. What your credit scores are play factor. You could have assets. So we do asset depletion. So let's just say you don't have any income, but you got a lot of assets. You've got a 401k, you've got retirement funds, maybe you got money in the bank. We can use a formula to determine what that would throw off in monthly income to help you make the payments. We can do for self-employed P&L loans. So this is just profit and loss. This is not audited profit and loss.
Right.
This is not some accountant coming in and going through. It's not tax returns, but this is your profit and loss.
You can do bank statement loans.
Bank statements.
Yeah, I did one of those for an STR I have in San Diego recently.
That's right. And so when we talk about bank statements, it's the deposits. So what are the deposits averaged over 24 months or even as little as 12 months? So we can take 12 months average deposits, divide that up, and that's your monthly income to help qualify for the loan. So there's a lot of really unique ways that we're qualifying people for loans, but always with the idea that they've got the ability to repay that loan. That's the biggest factor that didn't exist before.
Yeah, I'm glad you brought this up, and this is a good takeaway for the listeners is because I noticed a big difference, right? I got some of these personal STRs and getting lending for those. It's very like kind of the Wild West, and you can push through a lot of stuff. And depending on who you work with, it might adjust your loan proceeds by as much as 25, 30%, which is crazy. But I feel like with these commercial deals, like you look at your trailing 12, you know, NOI, and you look at your DSCR, and it's pretty black and white what you're going to qualify for, regardless of which lenders you go to. But I mean, these are, you know, lenders that are either local banks and credit unions that happen to do commercial, or Fannie Mae, Freddie Mac, and they do more conforming commercial stuff, like we see it on the multifamily side where they'll do non-recourse lending. But these perm debt lenders in the commercial side, it's very black and white. There's not a lot of like gray area, but I feel like in what you just said, there's a lot of gray area in the residential space right now, especially with the non-QM world.
Yeah, you're 100% right. And non-QM lending, that's what this is. So non-qualified mortgage. And for people that don't understand what that
what
is,
does that
there are
mean?
two buckets. There's
Okay.
qualified mortgages and non-qualified mortgages. Qualified mortgages are loans like Fannie Mae, Freddie Mac, FHA, VA. You follow their guidelines and they are qualified, and you are insured as a lender that they can't come after you for that loan, for making that loan. Non-qualified is the bucket outside of that, where we use other things to qualify somebody for a loan. And it's a little bit more exposure for the lender because they don't have that guarantee behind them. And because of that, the rates are higher on it. It's a more risky loan. But I will tell you that the guidelines are expanding, and they're expanding rapidly. So when DSCR started, say 5-6 years ago, you were looking at 75% loan to value. You'd have to come in with a 25% down to do a DSCR loan. Well, then it moved up to 20. And then a couple of years ago, it went to 15.
Yeah.
Guess what we can do today?
We're at
10.
For an investment property?
For a DSCR investment property.
Really?
Yes, we can.
Damn, that's crazy.
Yeah, that's right. And so that's where,
and ironically, the rates have gone up.
The rates have gone up overall, but they're coming down now.
Yeah.
So all these products are coming down, but the delta between the rate on a DSCR loan and a non-owner occupied, say Fannie Mae or Freddie Mac loan, is not that far off. So a couple of years ago, Fannie Mae and Freddie Mac, and we'll see if that changes, but they came in and did a 3% add, 3-point cost to do a non-owner occupied loan. So 3% cost over a standard owner occupied loan. So the delta between the rate on a standard non-owner versus a DSCR really isn't that much.
So this Fannie Mae product is for investment properties, not a second home.
No,
because second home / like a vacation home is different, right?
Correct.
Okay, got it. Interesting. Wow, 10% down on a DSCR. And what kind of loan amount can you go up to?
Yeah, they'll go up to jumbo loan amounts,
which is what?
If it makes sense.
What is that in California?
It's not really, it doesn't go by the standard, Fannie Mae jumbo loan amounts or high balance loan amounts. And I'm not going to remember what it is for 2026 because we just started, but they're up over $1 million. So every lender has its own kind of limit for the DSCR loans, but we can do them up to $2.5 million. We've done them up to $2.5 million.
Really? So Brad, you're saying anyone listening to this right now can go buy a investment property today. It could be a short-term rental, whatever, up to potentially $2.5 million, non-QM, meaning they're not going to do tax returns. They're going to look at other ways to qualify. You could do bank statements or maybe look at the DSCR of the property to go up to $2.5 million and only put 10% down.
Well, 10% down doesn't go up to the high loan amounts, but they can do that with 15% down.
Okay.
Yeah.
What's the limit on a 10% ballpark?
Everybody's a little different, so it's hard to say, but let's just say it's around $1 million. Yeah.
And if anyone listening to this right now is like, yo, I want to take advantage of this 10% down product, where can they go to get in touch with you?
Oh, just go to amerifund.com, AMERIFUND, amerifund.com, and you can get in touch with me through that. Or
There it is. And I back my guy, Brad. I've known him for quite some time. Good friend of mine. So check that out, amerifund.com for that 10%.
Yeah, thanks for the plug.
DSCR non-QM. I might have to hit you up, man.
Look, it has to make sense. The property has to throw off the right income. And if you got maybe a duplex or a triplex, maybe it does, right?
Well, here's where I'm at, Brad. I'm like, okay, we've been in a high rate environment for 4 years. It's clear that the Fed wants to start cutting some rates. They did 3 rate cuts to end the year in 2025. We got a new Fed chair coming in, Kevin Warsh. Some people were rooting for someone else, but Kevin Warsh is in here now. I've read some positive things about him. I've read some things that maybe aren't aligned with him slashing rates, so we'll see. But if you're a betting man, would you agree that there's going to at least be a handful of rate cuts in 2026?
Oh, I'm pretty certain there will be.
How many basis points in cuts do you think we'll see in 2026?
I think we'll see at least 3/4.
Okay, so we see another 75 basis points of cuts in 26. Well, right now, you can get some deals out there in the marketplace. There's some sellers that are like, hey, I got to get out of this. There's some deals out there. And if we see 3 or 4 cuts this year, maybe 75, maybe we see 100 basis points of cuts this year, then maybe going and getting that property for 10, 15% down in the long run, assuming that you buy in a good location, you buy it, below market value, and you don't have to sell this thing in the next year or two, and you can hold it for 5, 10, 15 years, I think I would give you the green light to go buy it.
I would add to that, it doesn't have to be below market value, because
Ooh,
what
really?
happened?
You would overpay right now.
Well, I don't think it's called overpaying.
Okay.
What happens when rates go down?
When rates go down, it puts upward pressure on pricing.
Why? Because there's more
There's
demand.
more demand.
So you're waiting for the rates to come down, right?
Uh-huh.
Well, guess what? Your neighbor's waiting for rates to come down, and their neighbor's waiting for rates to come down. And as soon as they come down, everybody's in the market. So if everybody's in the market and you don't see, there's still not a lot of housing starts and not new homes being built. So new inventory isn't coming on the market. So that means the only inventory that opens up is the loosening inventory. And those are the people that are like sitting on their homes because they have low interest rates. They now go, okay, you know what? I've got a 3.5% rate, but now I could get 5. That's close enough. I've got all this equity. I'll roll that in the new home. My payment will be reasonable. Okay, I'll sell my home. Well, now there's going to be 4 people looking at that home instead of 1. So are you better off buying now? We talk about this all the time. Marry the home, date the rate. Get into the house. Get in it now. If it's affordable, don't do it if it's not. Get in the house now. Let rates come down and refinance. That's it. Now you got the best of both worlds.
Yeah, 100%. And, and again, I still think like if you are buying right now, you should not have a quick timeline to sell, because that's where people get caught. So, like that's why there's not a lot of home flippers right now. People stop flipping. If you look at all the home flippers that were doing big volume in 2021, 2022, they're all wholesaling now. They don't want to have anything to do with holding these properties. But if you have a long time horizon, which is the way to buy real estate, I believe, especially if you're going to buy in good locations, let inflation do its thing, let time do its thing. There's going to be an opportune time in the next 10 years to have a nice refi event or a nice exit if you are looking to sell.
100%. I say this all the time. It's not timing the market. It's time in the market.
Yes,
right?
100%.
And so you can, look, if you buy a stock today and it goes down and you sell it, what happens? You lose money. But if you buy a stock today and it goes down and you hold on to it, and then in the next 5 years or 6 years, it goes up and gives you a return, have you lost any money? No, you only lose when you sell. So hold on to those properties. And you should be buying with a buy and hold strategy anyway, unless it's your primary residence and you've made enough on that where you can get the tax benefit of the 250 or 500,000 if you're married, tax exemption, and roll that into something bigger and better for the next one. If it's not that, hold on to the property long term. It doesn't make sense to sell it for any loss, because you can pull out that money when it does when it does appreciate. You can pull that money out tax free.
Yeah. Now, when the stock, if you invest in stocks, when the stock goes down, or crypto, these Bitcoin guys have been pretty quiet lately, that I've been having on the podcast. But I'll say this: when the stock market goes down, let's just say you own some Netflix stock and it goes down 30%, in order to get back to even, assuming you don't sell, it doesn't need to go up 30%. It needs to go up more, right? With real estate, because we're getting a lot of these assets using leverage, right? So let's say on average you're going to put down 20%. Well, now we're getting a 5x multiple on that return. So every time the real estate, let's just say, for simple math, you buy $1 million property and you put 20% down, right? Now this property goes up to 1.6 million, right? You didn't make 60%. You actually made almost 100%, because you only put down 20. What did you make on that?
You only put the down payment down.
You actually made a 300x return, a 300% return, versus 60%. You get a 5x multiple. And so that's the one thing about real estate that I love over the stock market or investing in crypto.
I'll tell you, the multiple is actually bigger than that.
Okay, explain.
If that property is rented out and your renter is making the payments, on that mortgage
Mm.
and the principal is coming down, you've got a bigger multiple.
And then I'll piggyback off you one more time. I'll say, hey, factor in the depreciation and the tax benefits, and then now you got an even bigger multiple.
Yeah, you got a layered return.
Yeah.
So yeah, when you're looking at returns in the stock market, whatever it is, even the S&P over a long period of time, and you see how crazy it's gone up, if
I'm
the
gonna look it
longer
up.
period
I'm
of
gonna look
time
it up right now.
you look at it, the more straight line it is, but it doesn't have those other facets. It also doesn't have the ability to pull cash out tax-free like property does. And so in my world, and this is where I'm comfortable, and a lot of people in the financial world are more comfortable with vehicles like stocks and bonds and so forth. But in my world, I'm very comfortable with real estate, and it's done right by me.
Yeah. I'm looking this up right now. Real estate versus stocks average annualized return since 1950s. And keep in mind, this is going to include real estate probably in the middle of the country, which is going to be a little bit slower growth. But I'm just curious, and it's not going to include leverage and tax benefits and all that, but I'm curious to see what it is. So it says the U.S. stock market, the S&P 500, with dividends reinvested, this compounding, has averaged 10% per year on a long-term basis going back to the 1950s. Now, let's see here. Now, adjusted for inflation, the real stock return is about 7% historically. Now, here's where it gets interesting. Real estate, including rental income, total return often estimated in the 8 to 10% range in some analyses. But this is home price appreciation, only 3 to 4% annualized. This is national. Let's go. How about California? I'm curious, because California is a little bit different beast, Brad. I know you're leaving the beautiful Golden State for the desert, but oh man, we got to look up to California. So California real home. I'm asking ChatGPT, and I don't see any.
Yeah, it's still the overall return. I would guess is much greater. Looking at the S&P over time, I actually did a post on this not that long ago. But again, it doesn't factor all those other things into it. The depreciation that you're able to deduct, the the fact that you can get rental income to pay down the mortgage, that you can pull cash out as a leverage tool to go buy more property, and so it doesn't take any of that into account.
No, it doesn't. It doesn't. You're not going to get that 5x multiple. And again, if you put down 10%, like you're talking, which is crazy, 10% down, you're looking at a 10x multiple return on your investment. Now, this in comparison only makes sense if you're going to pay cash,
right,
for a property,
of course,
right?
Which wouldn't be a smart thing to do.
Which I don't know. Well, I guess some people do it. So I'm trying to find something that's like, yeah, I don't see it here. I was trying to find something good. I was like, I'm asking ChatGPT, what is the average annualized appreciation rate for real estate that's in Southern California that's like coastal, like in coastal markets in Southern California?
Yeah, even that, I doubt it would be more than 4 or 5%.
I think it's got to be closer to 7 or 8.
Well, not over the long run though. I think that there might be periods of time.
Well, let me challenge you. Watch. How often does real estate double? That's like coastal real estate in Southern California. Would you say 15 years?
Gosh, I would have to really think about
that.
So
if you did 15 years,
okay, I think that's probably a reasonable statement.
Yeah, so that'd be like 7.5% a year.
Yeah,
right. 15 divided by 100 would be 7.5. If my math
6.5.
Yeah. What's 100 divided by 15? We're really testing the math skills right here, guys. Let's see. 100 divided by 15. 6.7. There we go. 6.7. So we'll see. Anyway, so we'll see what happens. You're saying 75 basis points of cuts this year. I'm gonna say 100.
Okay.
I think 100 will be a win.
It would be a huge win.
I think 100 will be a win.
Yeah.
I would take that. Now, we saw the 3 consecutive cuts at the end of the year. The 10-year Treasury kind of went up, right? So explain to the listeners, like, what is the spreads? What dictates the spreads?
Yeah. So a lot of people get confused. They think that the Fed cutting the federal discount rate means you're going to have lower mortgage rates, and they're not directly correlated. So the federal discount rate, and that's what the Fed controls, is the money that banks can borrow in overnight funds to stay liquid. Okay. And so there's certain liquidity requirements. A lot of this stuff came after a 2008 meltdown, but when they were increased, but that's the rate at which they can borrow those overnight funds. Now, a lot of times mortgages do follow that, meaning that, over the long haul, as the federal discount rate comes down, and it's more due to monetary policy than it is the actual lower federal discount rate, because the monetary policy is driven by the reports. So if you've ever noticed, uh, mortgage rates tend to come down when the environment is really tough economically. So think about the times where you've seen mortgage rates come down. Even think about COVID, right? What did we see? So we saw rapid inflation. We saw cost increases. We saw people losing jobs, earning less money. Things were bad. And so in order to catch up with that, the Fed had to change their monetary policy to get ahead of it. And that's what caused mortgage rates to come down. So what are we hearing right now? The most recent job reports. Jobs are, people are losing jobs. And there's less jobs on the market for people to get. So the combination of those things mean that we're probably going to see a period of time where it's a lot tougher for people. And most people would say that we're not seeing prices come down. Yeah, I know politicians like to talk about how gas is coming down, the price of gas. I don't know. I go to my pump and it doesn't look like prices are coming down.
No.
Yeah, I think I just paid $7 for a gallon of gas, in a coastal gas station. So
now,
look,
real quick on the jobs report. So there's fewer jobs available. A couple things here. What do you think the main reason is for that?
I think AI is playing a little bit of a factor.
I agree
there.
with that.
I also think that in areas like California, and we get a little bit tainted, I think, with our reports.
The minimum wage is so high here.
The minimum wage.
A lot of business owners are like, dude, I'll just do it myself.
That's right. If you have to pay somebody, this is for fast food.
Yeah.
If you have to pay somebody $25 an hour.
What is it right now? I know it just went up again.
Well, it depends where. So I think it's $25 an hour somewhere in like the Glendale area, if I'm not mistaken. One of those cities is $25 an hour.
I know my team was just recently asking me because we have housekeepers, right? Yeah. So some industry. So I didn't know it was based on industry.
Yeah, that's what I'm saying. Fast food industry.
Okay.
I think there's a couple of cities in Southern California that's $25 an hour.
Okay, so check it out. Statewide minimum wage, California, $16.90 as of January 1, 2026. Industries have higher minimums. Fast food workers in covered restaurants. I didn't know there was a such thing as uncovered restaurants. I guess it could be like a food cart, taco stand. $20 an hour. And then it says some areas have a higher than the federal minimum wage. The federal minimum wage is $7.25, huh? Did you know in Texas, if you're like if you earn tips, your minimum wage is like only a few dollars? I'm gonna look this up.
I think it's not only in Texas. I think North Carolina is like that too.
So how do you compete? Like if you're a restaurant or a bar in California, you got to pay $17,
Yeah.
and then to get tips.
Yeah. Well, why do you think that In-N-Out moved corporate office to Tennessee? I think that's happening a lot. So you ask what's causing this where there's not as many jobs available. I think automation, which includes AI. I think there's a lot more automation happening. I think that the cost of wages is going up, causes that to be accelerated. And then when companies leave the state, there's less jobs available. And there's a lot of those happening.
Brad, check this out. So in the state of Texas right now, base minimum wage, if you work at a restaurant or a bar and you make your money on tips, the minimum wage is $2.13.
There you go.
That is insane.
Yeah.
That is insane. And then in California, it's 17.
Yeah.
And my girlfriend Presley told me this, and I was like, okay, maybe this is 3, 4, 5 years ago, but this is as of today. That is insane. It's $2.13. Which state is the cheapest? This is crazy, man.
So you asked me why I'm leaving California.
Yeah, that's why.
There's a lot of reasons, but that's another one.
This is crazy. Wow. But so I get, is the takeaway if you're a restaurant owner and you want to open a restaurant, like you move to Texas?
Or any other state, California makes it really tough. They make it tough for that. They make it tough for insurance. I don't know if you've ever compared, you've got your employees here in California.
Yeah.
I'm sure you offer a health plan for them.
Yeah.
If your business was based somewhere else in another state, a lower cost state, your health insurance plan rates would be about half.
Okay.
It's a big difference.
Would payroll taxes be lower?
Payroll taxes are lower. Absolutely.
They are. Okay.
Yeah.
And then we do 401k match as well. But I mean, payroll taxes are expensive, so factor in that 20% on top. And then I mean, even these payroll services, the like ADP, we use ADP. That stuff's not cheap either.
No, but and I don't know that you'd see much of a difference there, but definitely on the insurance front. You've got properties in other states. How
Yeah.
about your insurance costs on those properties in California versus the other states? If you can even get your insurance, do you have properties here that you have to take California Fair Plan?
What is that?
So it's kind of the last resort for insurance. So I'll give you an example. I've got a property up north here that just came up for renewal, and they're not renewing me. Not that we did anything wrong, never had a claim, anything like that. They just decided this is not an area they're going to loan insurance in, or they're going to give insurance to
Too
anymore.
risky.
And there's no other insurance company that offer it.
Is that because the fires?
It's a lot of reasons, fires, floods, whatever it is. But it's California, like it's an epidemic here. We're in the mortgage business, we see it all the time. People can be in the middle of a town that's 2 miles from the hills, and they say you're in a fire zone, and they double the insurance. It's extraordinary how expensive it is. But now you look at insurance. So I've been obviously looking in other states, and you look at insurance and you start looking at the prices of insurance, and it's like half the price. Same coverage, half the price.
Now I'll say this though. Florida, in these flood zones in Florida, very expensive.
Yeah, and hurricane zones.
Very expensive. In the Northeast, you got snow. I think the cheapest is like these desert areas, like Las Vegas, like Phoenix, because you don't have a lot of natural disasters. There's no fires, there's no snow, there's no earthquakes, there's no tornadoes. And so I think, generally speaking, those homes, they last a lot longer.
But the environment, the state environment has also caused this to happen. They've made it
Oh, for
very
sure.
tough for insurance companies to be here.
Yeah.
And those that are left have to charge a lot because of the exposure. And so when you have less competition, rates go up. And that's what's happened. There have been companies, I'm sure your listeners will relate to this. There are companies that just completely pulled stakes, that they used to be able to get insurance from here in the state, in California, and now they can't. And so those are, there's a variety of reasons. So there's outward economic pressures as well that I don't see changing anytime soon. Like I've been waiting for it. I grew up here. I'm a California kid, and they're just not changing.
I'm curious for you. What was the tipping point for you and your wife, Laura? Shout out to Laura, by the way. What was the tipping point for you and Laura to say, hey, we're out of here. We're leaving California after what? How many years have you been here?
Well, I've been here since I was born, but we've been in our house for 27 years. And, I've got all my, not all of them, but a majority of my properties are here in California.
So for you guys to pull the plug and just say, yo, we're out. We're leaving California. We're going to Vegas. What was the tipping point?
I think it's really a combination of things. It's higher crime rates. It's the cost of being here for those things that we just outlined. It's the insurance. It's the homeowner's insurance. It's health insurance. It's the cost of living, including, gas prices. And it's not like I can't afford it, but I just feel like I'm wasting my money. Like, the first $100,000 I make in a year just goes to paying expenses that I wouldn't have somewhere else. So there's all that. There's some geopolitical stuff. There's crime rates, the roads. How many times have you driven on a road outside? We'll use Vegas as an example, and you're like, holy shit.
Yeah.
My car is really quiet.
Yeah.
Right? Because the road's all smooth, and you're like, this is amazing. You drive, I drove down here, down the 5.
Potholes.
It's a mess.
Yeah.
And it's funny because Mike and I were driving, and, there is a stretch, and I'll ask you if you know what it is. There is a stretch of the 5 where you're like, oh, and the 405 has the same thing. You're like, oh, this isn't bad.
Yeah. The stretch you're talking about is in San Clemente.
It's actually further north than that.
Further north, Irvine.
Orange County,
Yeah,
Irvine
okay,
area.
okay, got
Yeah.
it.
That for some reason they really take care of those roads. But outside of that, it's like, it's a hot mess. I've popped, when I have low profile tires, I pop tires in potholes.
Yeah, I have too.
So where's our money going?
Yeah.
Really, where is it going? Homeless is out of control. You have that downtown here, right?
Yeah.
You can't even walk a block without smelling piss.
In East Village, yeah. It's a real thing. You go over to East Village right now, and this is a lot of downtown areas in California. Mind you, I think San Fran's a lot worse. But if you go to East Village, you will see, depending on time of day, you'll see guys walking around with their dicks out.
Yeah.
Like it's like a zombie apocalypse.
Yeah. So I think it's all of those things. Why don't they care? It's not like we're not paying enough in taxes. It's just so mismanaged. And, I want to have control over my own money. So I think those are all the factors. And of course, I'm in a little bit different position. I'm a little bit older. My kids are growing up.
You're
And
just
so
getting warmed up, Brad.
I've
This is
got,
just the beginning,
I've
man.
got a little bit more mobility than maybe some
Yeah.
do. But, we are, I think they said the most recent stat is there's somebody moving out of California every 4 minutes.
I'm gonna look this
Look
up.
that one up.
I'm gonna
I
look this
just
up.
heard that.
I'm gonna look this up because with people leaving though, there's also people coming in. I know here in San Diego. Now, I'll say this, Brad. I'm biased because out of all the major markets in California, Bay Area, Los Angeles, Orange County, and San Diego, I think San Diego's hands down the best.
I agree with you.
Best beaches, best climate, and it's the least liberal, which I kind of like. But I also think that a lot of people move here from cold weather cities. I see it happening. So people that grew up in Boston, Chicago, Cincinnati, all these cold weather parts of the country, they move out here and then they just fall in love with San Diego. They never leave. I can't say the same for LA. I can't say the same for Orange County. Like for me, I would get bored out of my mind in Orange County. And then Bay Area, same thing. I'm just the weather's not good. It's too big. There's a lot of issues up there. San Diego for me is like I'm biased.
And you travel a lot, so you'll
I do.
recognize this too. When you travel to other states, and it's not everywhere,
Yeah.
the people are different. They're more friendly. I'll give you a really great example. So if you go, you go to your local CVS here, you go to the grocery store, whatever it is, and you check out, for the most part, it's just a service. Like you're walking through, nobody cares. Nobody's talking to you. Nobody cares what you're doing. And you literally have no interaction with people. People don't say hello to you. Like that's the culture. And it's no surprise. You don't even recognize it. In these other areas, people genuinely have an interest. They're genuinely nice. Hey, have a nice. They'll wave. You don't know them. They'll wave to you when you're walking by or jogging by. Like it's a whole different thing. You see, Oscar's agreeing. It's true. You go. It doesn't matter where you're at. California is just not like that.
Now, I agree with you, but I'll challenge you in that I think San Diego is like that. Because I lived in this neighborhood. I've been here 8 years now. And because it's a melting pot where everyone comes from all these cold weather cities, they don't know anyone. So they're forced to talk to people to like make friends. And so the weather's always good. So I feel like here in this area, at least where I hang out, people are friendly. Now I agree when I go to LA or I go to like Bay Area and I'm like, it's like people kind of zone you out. It's weird. It's like what do they call it in Seattle? They call it the Arctic freeze or something. What do they call it? The Seattle freeze?
That's what it feels like.
Okay, check this out.
Okay.
You're not going to believe this. You're not going to believe this stat. So I asked ChatGPT, I said, what was the net migration in California in the last couple of years? And so I got 2024. It doesn't have 2025 numbers yet. But in 2024, guess what the net migration was in California? Was it positive or negative? Meaning more people leaving or more people coming?
Well, I have to guess more people leaving. But
Okay.
the way you're asking it is the opposite.
Yeah, your intuition's good. If you think there's more people leaving, how many do you think left in 2024 from a net migration?
I would say
standpoint?
4-1.
Okay, so the net migration in California statewide was plus. That means more people coming in than leaving. Plus 121,500
in total.
In total,
yeah.
I would have never guessed that.
I certainly wouldn't. And maybe Chad isn't always right, by the way.
But this is what I'm curious.
It's not. I'd rather you Google that.
But this is what I'm curious. What was the average income level? Or how about we'll go average median, and we'll just say average income level of people leaving versus coming. Of people.
Oscar, Google that same thing. What was net migration from California in 2025?
People leaving California based on top destinations. Californians chose Texas, Arizona, Nevada, and Florida. And average household income for those folks, this is interesting. Arizona, people that left California for Arizona made $100K on average. People that left California for Texas made $145K. People going to Nevada made $134, and the folks going to Florida made $187K. So I wonder why that is. I know Arizona makes sense, cheaper cost of living. But interesting. Now, inbound households from major states often had gross incomes less. Interesting. People coming from Texas,
younger,
106.
wanting opportunity.
From Arizona,
Sure.
77. From Nevada, 86. And so that makes sense. So it's like, for the single guy out there, the single girl that's like, hey, I want to go live in California. I'm
Everything's
just getting
happening
started.
there.
I don't have
Yep.
a family. I'm not married. Like, I'm bored with where I live. Yeah, do it. And then for the folks that are like you, like married, kids are growing up, like you're like, hey, I wanna just leave the riffraff. That makes sense.
It does make sense. That stat I'm not surprised by.
Mm.
Oscar, did you get anything on the nothing?
But
Okay.
also
How about you, Micah? Did you find anything?
it could be like,
The net migration for California in 2025, people leaving versus coming.
it also could be people get kids and then they're like, hey, this is getting expensive. You get 3, 4, 5
I
kids in
think that-
California.
yeah,
That's not cheap.
absolutely.
And maybe your spouse has to work in California, but if you move to Arizona, your spouse doesn't have to
You're,
work. She
you're
can
actually
stay at
bringing
home
up
with
a
kids.
really good point because I spoke to a potential mortgage customer the other day, and they're looking to move from Sherman Oaks, you know where that is, to Calabasas. Not because it's less expensive there, it's very similar, but because the schools are better in Calabasas. So in Sherman Oaks, they got to send their kids to private school, and they're like, this is costing me way too much money. I need to go somewhere where the schools are better because the cost of living is eating me alive. So I think that is a good point, that I think cost of living when you have a family is a much bigger concern.
I mean, there's a new gym out here in San Diego, Equinox. My girlfriend and I go there this morning. It's like $410 a month for both of us to join there. That's crazy. And so in California, I mean, $100,000. It's if $100,000 here, especially if you have kids. I mean,
How
good
do you
luck.
live?
Good luck. Yeah.
Seriously. I
Because
don't know.
11% goes to the state, or is it 13?
13.
13 goes to the state. 30% is going to go to the Fed. So that's 40% gone right there. You're going to have some go to Social Security taxes. And then
Well, you got in all the other taxes. There's sales tax, there's gas tax,
car payment, $500.
Insurance.
To rent a 1-bedroom apartment here in this neighborhood, it's $3,000.
Wait. In San Diego, a 1-bedroom apartment costs $3,000
In
a
this
month.
neighborhood that we're standing in right now, where the podcast studio is, Little Italy, downtown San Diego, a 1-bedroom, $3,000. And if you want to be in a 1-bedroom in like a nicer building, you're looking at $4,500.
That is crazy. That right there tells it all.
So how do you do it? I mean,
how do people do it?
That's why people.
How do they do it?
That's why people have roommates.
Yeah. Or maybe that's why debt is at an all-time high too. Credit card debt.
And I think another reason why credit card debt is at an all-time high is because the way that a lot of people re-up on liquidity to pay off credit cards and pay off debt is they refinance their primary mortgage. No one's been able to refinance for 4 years. Even if you're a doctor or attorney making $400K, $500K, you probably have kids that are in private school. You probably have an expensive mortgage. You probably have 2 car payments. Those folks even need to refi their primary mortgage to re-up on liquidity, and they haven't been able to either. So, I mean, I think right now, I mean, this is the last year and a half, I think, for a lot of business owners, I think has been a grind. Liquidity is an all-time low. Like it's not supposed to be easy right now. It's not supposed to be easy right now.
And it isn't. So, a lot of things have to shake loose, and we'll see. It'll be an election year next year. There's, we'll see what happens, if there's going to be any turnover. I've just gotten to the point personally where I'm just at the end of the rainbow. I've enjoyed California my entire life. I really have. It's been my place. But now I'll travel and people ask where you're from, and I'm not from LA, quote unquote.
Are you
So
from
I
Vegas?
won't say LA.
Are you going to say you're from
used to say-
Vegas?
well, I probably in the future. But now to say you're from LA is kind of a negative. There's a negative feeling. And so when that starts happening and you're kind of like, what? I think that the writing's a little bit on the wall. Now, look, San Diego is beautiful. I agree with you. My daughter just moved down here. I used to live here decades ago. It is great. I love it.
So
But
is
you
it
still
safe to say
have-
you're going to be in San Diego a lot visiting the daughter?
I think that's safe.
Okay.
I think
Okay.
that's a safe statement. Oh, you found something. What did you find, Micah? All right, let's see. Let's see what we got here. In California, or in 2025, California continued to experience a net migration loss, ranking last among U.S. states for the 6th consecutive year, with a net domestic migration loss of over 200,000 residents.
Okay. We're gonna fact check all
So
this
this
data.
is where I'm telling you that, like,
We're gonna have to
chat
fact check
is not
this data.
always right.
Okay.
This is off of Google.
Google's
And
not
then
always right either.
no, it's not, but it does have
But
references to where the data is
source?
from.
What's the source? U-Haul?
Yeah, that wouldn't be a bad source, right? Federal Immigration Public Policy Institute of California. So this is what, where it's getting its data from. California Department of Finance. There's a few things here. So yeah, no. And so I think the real numbers are probably higher than that, honestly, because who wants to publish that you're losing that many residents? But I suspected it was that much. Again, they said every 4 minutes somebody's moving out of California. Didn't talk about how many people are moving here, but I do think you're right. Probably younger, more mobile, looking for opportunity, moving to, and older kind of cost of living is getting them moving away.
Yeah.
I think makes sense.
Here's my whole thing from and I never get super political or anything like that. Like or religious. Like I believe in just being a good human being, and I believe in building a good quality circle. But this is where I stand politically. I always say I don't believe that you should tax or punish Americans who work and improve to give free money to those who don't work and improve, i.e., the people that are on the streets panhandling, not being a contributing member to society, doing drugs on the side of the street, drinking alcohol, 40s, bottles of 40s at 9 o'clock in the morning on a Monday. If you look at the highest crime rate, if you look at the highest crime rate cities in the country right now, the highest crime, the highest drug use, it's going to be some of these more liberal areas like Baltimore, like Chicago, like San Francisco, like Los Angeles. A lot of trash, a lot of bums on the street, high crime, needles all over. And so I think there's something to be said about just politics, like local politics and how everything looks. And it goes, there's an effect of everything. I'll give you an example of this. If you're in San Francisco and all of a sudden the politics change and now you got all these bums on the street in tents and it looks like the zombie apocalypse, people are walking around with their dicks out. Well, guess what that does to tourism, right? These local businesses and these local restaurants, people don't want to come and visit these areas anymore. And so if you're a restaurant owner, you're a business owner, that negatively affects your business, right? And so there's always a ripple effect, and it all starts with the politics. And I think a lot of people out there don't, at least the people that are watching a lot of news and are like easily influenced, I feel like they don't really truly understand how politics affects everything.
It's true. And they get indoctrinated. And it's the same thing that happens with, this is kind of the term that we don't use anymore is brainwashing, right? Because brainwashing kind of has a political kind of war type feel to it. But, the more you ingest, the more data you ingest, that's all one directional, the more you believe it. And so I think that that's what's happened is that news is so readily at people's fingertips, and the giant tech firms are controlling what you see and feeding you that information. And so it becomes your reality. So it's not necessarily their fault. Those of us that have a little bit more wherewithal to take information from different sources and then make our own decisions and not just believe the information that's being told to us, but literally take it a step deeper and really determine whether this is real or not real. Like right now, we're talking about migration from California. What do you believe? Do you believe what chat says? Do you believe what somebody posted in your TikTok feed? Or do you do a little bit deeper research and really figure out what's good information? It's a good example, but they get indoctrinated in that pattern of thinking. And then that becomes kind of a mushroom. So then they hang out with people that think and feel the same way. And then that spreads. And so that's why you get areas, whether it's communities, cities, pockets, larger than that, that overall have a very similar feeling. So here in California, if you think differently than the majority here, you're ostracized. You can't really give your true opinion without being ostracized. And so you have to be really careful about what you say, how you say it. And it may be the logical thing to say, and you may be 100% right, but the narrative isn't right. And when the narrative isn't right, then you're tossed aside. And so it really shouldn't be like that. I think your statement of, hey, I just like to be a good person. I like to be good to other people. I think that's the way everybody should be, right? And it shouldn't matter the way I think or you think. That's all healthy, right? You should be able to think your way and I think my way, and we have a healthy interaction and exchange. And maybe something I says influence you, and maybe the other way around. But when you are just very focused on one way of thinking, one mindset, and aren't open to other ideas or thoughts, that's when we wind up in trouble.
Yeah. No, you said it very well. It's like, I don't care if you're Democrat or Republican. I believe that when you give free money to those who don't work and improve, and you take money from, or you tax punish Americans who work and improve, and you give free money to those who don't work and improve, you indirectly incentivize the second behavior.
You do. But if the majority are the latter, then they're going to vote for everything that takes from the former. And that's the position that we're in here. So the harder we work, because I work my entire life, I've never missed a day of work. I don't get sick. I don't miss a day of work. I work every day. And, unless I'm on vacation, of course.
Yeah.
But I work every day.
Yeah.
And so if you're somebody that doesn't do that, and you can vote for something that you perceive is going to make your life easier because it's going to cost me more and benefit you, you're going to vote for it. And if that's the majority of the way that people vote, then that's what you're left with. And that's why we got 13% state tax. That's why we're taxed to the gills. That's why our gas is up. That's why everything here is so expensive. And if you're a small business, what we have to pay for insurance and what we have to pay for the cost of running that business is extraordinary. It's hard to survive as a small business. Now, we're not talking about big business here. We're not talking about giant corporations. We're about people putting their blood, sweat, tears. When they're short on payroll, they come up with the money out of their pocket to make the payroll. We're talking about those people are getting beat up. Then you got to be able to say, is it worth it? Is it worth it because the weather is so damn great?
Yeah.
Or is it not?
Yeah.
And that's where I think we're seeing the net migration loss.
That's really good. That's powerful. That's really powerful. Yeah. And the last thing I'll say about it is this is like, and you said it very well. I never get like political. I believe in being a good human being. And my viewpoint on politics is really just from like an economy standpoint. It's really all it
it's
is.
through that lens.
That's the only lens.
Yep.
I'm just thinking logically.
You're thinking about
logically.
it because you're a businessman.
Yeah.
You're only thinking about it from that point of view, because I think most of us meet in the middle. Like, we want to be good to other people. Yes, if somebody's mentally disabled, they don't have any family, they can't take care of themselves, scoop them up off the street. Let's fucking give them somewhere to live, take care of them. 100% for, like, most of those people are like that, right? They can't be rehabilitated. The ones that can, give them the avenue to get rehabilitated. It's hard to come out of the gutter when you don't even have a clean shirt or whatever and go get a job. Like, let's give the vehicle to do that. Why should we spend $23 billion and not see any benefit from that when it's our tax dollars paying for it?
I agree. There's no more empowering feeling in the world than to wake up as an American and feel like you have control of your future. You have control of your destiny. You have control of how today's going to go, how tomorrow's going to go. There's no better feeling than that. And I think everyone should be empowered to feel that at some point. And unfortunately, with all the bureaucracy and all the red tape and all the government intervention, a lot of these folks that are on the streets with needles and doing drugs and drinking bottles of 40s, drinking 40s at 9 o'clock in the morning, they're never going to experience that, unfortunately.
And I just don't think that a lot of them just don't have the control over that. They've gotten to the point where life, it doesn't matter anymore. There has to be a mechanism to catch them early enough. But to go back to just the political side of things, I'll tell you this. Until I turned 45,
Okay.
I never cared about politics, didn't think about it, didn't think about Republican, Democrat, never thought about any of that stuff. In fact, I don't think I voted in all elections. I voted in some, but not all of them, because I didn't really freaking care. Like, I'm just doing my business. That's not my life. Like, my vote isn't going to matter. But when these apps came out and they started connecting people in real time, it is crazy how young people are that really care about this stuff. And they really shouldn't, because it takes the eye off the ball of their own lives. Like, who cares? Who cares what the news says? Why do you keep ingesting this stuff? If you really concentrated on your own life and improving your own life every single day, whether it's going to the gym or exercising your brain or going to work and improving yourself or starting a business or coming up with an idea or building friendships or building love, and that's all you did every day instead of ingesting that crap. And you see the people, they're mostly anonymous. you don't have a real profile, posting just all the negativity online, take that and channel it into something good. We wouldn't be in the position we're in, but we don't have control over that. They're controlling their brains. We never will. So what can we do? We can only control ourselves. And I'm controlling myself to walk right outside of the fire.
Yeah.
So
I feel you. So, tell me what you're doing with HomePie. It's a
yeah,
revolutionary thing. You're really, obviously throwing a little splash in the marketplace or buying Fizbo, but tell me what the hell you're doing, man.
yeah. So
Break it down for us.
I think that most people in your audience can recognize that buying and selling property is way too complex and way too expensive. I think that's evidenced by everything that's gone on in the last couple of years. It started with the NAR lawsuits. So for those not familiar, there were lawsuits, class action lawsuits against National Association of Realtors, along with all the major real estate firms that basically claimed this. And I'll just break this down to kind of the easiest way to say it. They claimed that buyers overpaid for property because they were not able to negotiate their agent's real estate fees because it was built into the listing agent's fees and they got half of it. Okay. So what does that mean practically? It means that sellers agreed to pay through their listing agreement 5 or 6%. And the agent, the listing agent, agreed that if a buyer's agent brought a buyer in, they would split it with them. Okay. That's generally what it was. But if you were a buyer and you maybe had a close friend or a relative that said, well, I would just do it for you for $500 or I'd do it for 1%. You weren't given that ability to do that. So instead, you paid more for the property because the seller was considering the 6% they were paying when they wanted to accept your offer. So you had to pay more for it to get that. That was the premise. And I'm really breaking that down to kind of the rawest terms. They won. Huge. Hundreds of millions of dollars lawsuit. It changed the business forever. Now, I don't mean it changed it structurally, because in a practical sense, it didn't. People are actually paying more for fees now than they were before. But it said no more coupling of commissions. The listing agent gets paid based on a contract with the seller. The buyer's agent gets paid by contracting directly with the buyer. So you go buy a property today, you sign a buyer agreement to agree to pay a certain amount to your agent. Now you're making an offer and you're asking the seller to cover your buyer agent fees. That's the way around it. So the seller's still paying for it, but you're able to negotiate your side of it with your agent. So
is that the norm that's going on right now in the
oh
marketplace?
yeah, that is exactly.
So the offers are like, hey, the seller, you're going to cover X amount of points towards the buyer agent.
100%. Like you're very few people are going, I'll take care of my own buyer's agent fees. I want a better deal on this property. Okay, very few. It's a minute amount. So you're my real estate agent, and I go, yeah, hey Rich, I already found this property on Zillow. I already, took a look at it, the open house. I'm ready to write an offer. I don't want the listing agent to, have this conflict of representing me and the seller. Would you go ahead and write that offer for me and represent me for 1%? And you're like, hell yeah, I didn't do anything. Sure, I'll do that, right? Well, now you can do that, where before you couldn't. Okay, so that changed, right? But you weren't able to do that before. That was really kind of started the ripple effect. So people started, for those of you that have been buying or selling, or you're in the market, or you own STRs, or you flip properties, you know this stuff. And the more sophisticated you are, the more you realize, like, you either have your right-hand guy that's taking care of you and not charging you as much, right? Or you're factoring in these higher costs into your cost basis, right? Of what you're paying when you're flipping that property and you're selling it. Well, what if it was a lot easier? What if it wasn't so complex? And what if you could sell it on your own without paying that commission, or a very small amount for somebody to just guide you through that process? Well, that's what we created. So HomePie created technology, is proprietary, that walks somebody through this archaic way of writing offers and negotiating the offers and all the back and forth and emails and all these things. And we've digitized the entire process in a very easy app that makes it easy to write offers, negotiate them, and produce an agreement. It can happen between buyer and seller directly for sale by owner. It could happen between a seller with a buyer that has an agent, so they're represented. And eventually we're going to have agents that can use that as well, and it can go agent to agent too, okay? So revolutionary technology, and it goes much deeper than that. It goes into the transaction. It brings in all the third parties like mortgage and title and insurance companies and movers and all these things, right? Really revolutionary. Well, not only have we done that, it's existed for a while, through other sites, but not as sophisticated, but we're now acquiring FSBO.com. which
Big splash.
is,
Big splash.
that's right. Boom.
Boom.
Uh,
Fizbo.com
it's a
for sale
big,
by owner.
it's a big deal.
That is a big deal.
It's been around for 26 years. It is the Mac Daddy of for
Woo.
sale by owner. The
How
site
long have they
is
been around?
since 1990, I think 1998. Okay. 4-letter domain, all those things. But it doesn't really have any technology that powers it up. It just gives somebody the ability to get on the MLS, right? And that's it. You can pay $3.99, get on the MLS, and you manage everything yourself. So the idea is to modernize that, still be able to do the flat fee, and but then give other services as well, all the way up to, we do a 1% full service virtual. So you can have an agent that guides you through everything virtually. You just go and you show your own property, or you go, view your own property. So all the physical stuff that's in person, we don't do. Very successful, very easy, and you use all the technology to guide you through. So it's a big deal. We plan on bringing in mortgage originators from across the nation, real estate agents from across the nation, title companies. Everybody's going to plug into this, and we're going to modernize the way that people buy and sell property, drive the cost down, and make it easy for anybody to do it regardless of their experience level.
What's the benefit of a real estate agent using you guys?
The streamlined process, they'll be able to use our technology for that. Look, I'll tell you this. A lot of people think they want to sell their own home. And if you're a professional, if you're a flipper, if you've bought, 30 homes and you know your stuff, or you have your license on the side, but it's not what you totally, fine. You can do it all on your own. I do it by myself. You don't need an agent, okay? I do believe that agents bring a lot of value, and 70% of people that think they want to sell their own home ultimately are not successful, and they hire an agent anyways. And so they'll come into the process thinking they want to do it, but guess what? They won't do the right things. They won't stage their property and clean it up. They won't get real professional photography. They won't put a for sale sign on their property, a real for sale sign, not the red and white sign. They won't do those things for themselves that a really good agent would do for them if they hired them. They just don't do it. They overprice it. They think that you're going to price it. You know this. So I'm going to ask you a question. You know this more than anybody. What is the value of a property? How much is a property worth?
What someone is willing to pay for it.
Thank you.
Mm-hmm.
What somebody's willing to. So if your property isn't selling, guess what? The number one reason is that it's not selling.
It's overpriced.
It's overpriced.
Yeah.
It's overpriced, period. End of story. It's overpriced. Now, you can enhance the ability to sell it at a higher price by getting better photography, by showcasing it, by all those things. But at the end of the day, you want more people to see your property, to stop the scroll, see it, drop on it, go, ooh, and be interested in it, and have more buyers, more demand for your property, and that'll drive the price up. Because if you like that property and I like that property, and your wife falls in love with it and my wife, then we're going to want to do what we can. And I see it all the time. I see offers go in with escalation clauses because they fell in with the property. It just has to be theirs. It's the right neighborhood. It's everything. And they say, whatever offers you get, we'll give you $10,000 more. And they wind up with that property. But guess what happened with that seller? They got a higher price. But guess why? Because they priced it right to begin with. So these are the things that you've got to do. So regardless of people wanting to start the process as a for sale by owner, we'll help guide them through that. But ultimately, at the end of the day, there'll be real estate agents that'll be on the back end of it that they can hire that understand the mentality of somebody wanting to save money. We'll help them save money, but we'll also get them the highest price and show them where they'll net more. So that's really what this boils down to. If there were people that understand the mentality of listing it properly and doing all those things, they don't have to pay any commission. You literally don't.
Say that again, the last part.
If there are people that understand how to list their property right, the lower the price, not the higher the price, having the right photography, staging the property, doing all those things for themselves that a good agent would do for them, they don't have to pay a real estate commission.
And how should a seller or homeowner maybe listen to this, that they want to use you guys, HomePie, and not hire an agent, not pay the 5%, 6% in agent fees? How should they know how to properly price their house?
Most people actually know what their house is worth, unless they're in a very unique property that there's no comparables. But most people live in areas where there's neighborhoods that there's properties that are just like theirs, or models that are like theirs, or an attract home. they're not that difficult to figure out. Okay, somebody sold their home. It's the same square footage as yours, 2 blocks away. It was 5 months ago. Yours has a pool. Theirs didn't have a pool. You can kind of compare these things. That's what appraisers do. They go and they pull the market data, and then they compare your property to theirs. They give it an age factor. That one sold 5 months ago. The market is increasing or decreasing. I'm going to add or subtract from that. Theirs didn't have a pool. Yours has a pool. I'm going to give you a little bit more value because of that. The condition of that one was not as good. We call it C3 or whatever. Yours is better. You're going to get yours is worth more. So most people can really kind of factor that out. They can use things like the Zestimate and other estimates that are out there to give them a general idea. But the reality is that most people kind of know what their house is worth. But everybody believes their home is the nicest home in the neighborhood and is worth more than everybody else's, right? Everybody believes that. So if you can get mentally over that and not fall victim to that and overprice your home, then you can sell and not have to pay a commission. But most people won't do that. And so they need some guidance. I'm going to add one more thing.
Yeah, go ahead.
When I said real estate agents, I really believe they bring a lot of value. I do believe it. 98% of agents are really not that good. And the 2% don't like the 98%. They don't communicate. They don't call people back. They're terrible negotiators. They get in the way. They cause people panic through a transaction and cause it to fall apart. 98% of agents are like that because the barrier to entry to get your license is so low. Okay.
I feel the same way about mortgage brokers.
And it is true. Maybe a little bit lower percentage.
More like 90-10.
Yeah. It's probably closer to 90-10. The 2%ers bring a ton of value, and they're going to get you a higher price for your home because they know what they are doing. Find yourself a 2%er if you're going to hire somebody to do the listing. But on the buyer's side, the value is so tremendous. And I'll give you really great examples of this. If you were, Rich, going to buy a home in, I don't know, let's say Kentucky. Okay. You had to have a property.
Shit
in
really hit
Kentucky.
the fan if I'm going out to Kentucky. Damn.
But
I actually, ironically, I just sold an 8-unit property out in Covington, Kentucky.
Oh, well, who knew you?
I had 2 small apartment buildings in Cincinnati, 11-unit and 8-unit. The 11-unit was on the Cincinnati side. If you go to the south side of the Ohio River, it's still a Cincinnati MSA, but there's an area called Covington, Kentucky. I had an 8-unit building, and I actually just sold that last year.
Oh, okay.
So not too far fetched.
So let's say Kentucky.
I won't live there.
I wanted to pick somewhere there was no way you could have property in. But if you don't know that area,
okay,
how do you find out where to buy? How do you find out what neighborhood is? This is a bad neighborhood. This is a good neighborhood. You can't do this stuff online. You can't really figure it out. Or let's say you had kids and they were 2 and 4 years old. How do you know which neighborhoods have 2 and 4-year-old younger kids that they can hang out with? You got to have a local expert.
What about YouTube?
It still doesn't give you that information. When you get into the buying mode, you've got to have somebody guiding you through an area that you don't know.
Okay.
You need a local expert.
So you think if you're buying a home, more important to use an agent than if you're selling?
So much more, especially if you're a first-time buyer
and
you're buying an area that you don't know.
Yeah, I can see that.
Yeah.
So do you think that as a buyer, if a buyer uses Fizbo.com or goes to HomePie and buys a for sale by owner listing, do you think the odds are they can get a better deal than just going to the MLS?
Yes, and it mainly comes from the cost of the seller. Because if the seller's cost is lower, they're likely to give you a better deal. Now, it's not always. Sellers get greedy. But if the seller gets an offer from somebody that has an agent and the buyer is asking them to pay 3% toward their fees to pay for their buyer's agent, and somebody else comes in, maybe with an agent with less fee or that says, hey, I'm doing it on my own. I don't need commission on this. I don't need you to cover commissions. They're likely to get a better deal. I mean, I had a deal like that actually not that long ago where I wrote my own offer. Because I know
a licensed agent?
I carry the same license that real estate agents do, but I don't practice it. But I use it for my own purposes. And the seller and the listing agent both said, well, if we don't have to pay that 3% commission, yeah, that's a reasonable offer. So I got a better deal.
Yeah. What are some other benefits of Fizbo.com HomePie?
It really is. It doesn't matter your level of experience. You can jump on the HomePie site today and eventually the FSBO.com site. And will guide you through the entire process. The searching process that you're already used to on Zillow and Redfin and Realtor.com and all that, that's all the same. Search, find, share, like, create a search list, all those things, favorite them. The biggest difference is you can connect directly with the sellers through instant chat on the site. And this is all done. It can be done from your mobile device or your computer. So you can have direct instant chat with sellers, ask questions about it. You can schedule a virtual or in-person tour. But when you're ready to write the offer, there's a button that says make offer, and it will guide you through the entire process, step by step. So think of it like TurboTax, where it asks you questions and then changes the next question based on your answer. That's what it's like. And so you answer bite-sized pieces, and at the end of the day, you have complicated tax returns that were all filled out. It's kind of the same thing.
So you could, as a buyer, or maybe someone listening to this, they could go to homebuy.com and submit an offer on any property.
That's right.
Through your site.
That's
and
right.
You guys will give them guidance on how to do so.
It's all built in.
Wow.
Yeah.
Okay.
Yeah.
Interesting. Okay. So
there's a lot more to come.
A lot more to come. I like that. Now, who is the right person to sell their home with HomeBuy?
Really, probably the mentality is the DIYer, somebody who either already knows real estate and is comfortable with that, or they just know that they can do anything if they just have the guidance. Your average person that maybe is really, so I guess, let me back up a second. There are two types of people out there. People that value their time more than money, and people value their money more than time. Which one do you think is the largest?
The typical seller that's going to do for a sale by owner is going to be someone that values their money more than their time.
That's right.
Yeah.
And so if you're, whether it's because of the period of life you're in, or your situation right now, or your job, you have more free time, whatever it is, if you feel that saving money, doing some things yourself makes sense, you're the right candidate. If you don't have the time, you're a high-powered position, have a high-powered position, you're working 48 hours a week and all these things, you're probably not the right candidate to sell your own property. You need to hire somebody to help you.
Now, because of this, is it safe to assume that the higher end properties, larger price point, those owners are more likely to just hire an agent because they likely value their time more than the money?
Yeah,
is that true or no?
It is true, but there's a caveat there.
What's the caveat?
And that's not everybody. So there's a lot of high priced properties that the owners have an ample amount of time and they're cheap. They just want to save it all. So we had a high rise condo here in San Diego that used our services and sold their property for $3.5 million. So, but they were, they weren't working, and, they're just independently wealthy, and they're like, hey, I'll just sell it on my own. And so it really depends, I think, more on the person than it does the property.
Yeah, I love it. Brad, I appreciate you coming on the show, my man. Always good to catch up. And you got a free giveaway for the listeners. Drop it.
I do. So
what do you got?
Look, if you think you want to sell your own property, you need to get on the MLS. We have a flat fee program called the Pro Listing. For $399, you get on the MLS. Well, with the code, if you go to thebradrice.com/summers, you can get a code and enter that in, and we will make that free for you. So no cost to get on the MLS and check it out.
Free listing on the MLS. So basically, anyone listening to this right now, they can just put the code in. They get a free listing.
That's right.
On the MLS.
That's right.
Wow. Crazy.
Good for 60 days.
thebradrice.com/summers. Check it out. He's Brad Rice. I'm Red Summers listeners. Thanks for tuning in. We'll see you guys in the next one. Peace.